Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here, home studios today for today's podcast. I got a lot to talk about. Huge news here regarding the Fed's favorite inflation measure, core PCE. Market's certainly moving here quite a bit based on this data. It's definitely something we've talked about, have been expecting for quite some time, and I'm very much looking forward to next Wednesday's Fed meeting day. So we'll talk about all these things and then some, but welcome back here on Friday, right at the end of July, essentially. How you doing, man? Your summer been treating you all right?
Summer's been great. Yeah. I have no complaints. So how about you?
It's great. Obviously, it's NFL training camp season finally kicking off here in Cincinnati, pretty much across the entire NFL. So I'm a huge Bengals fan. I cannot wait for the season. Hopefully, everybody's going to be healthy. We can pay Jamar, and everything will be awesome. So that's what we're planning on for.
Yeah, I'm hoping to pay Jamar, as they are saying on Twitter. X
Yeah.
now, I guess. But
And the
for
Super
me on
Bowl,
my end, big basketball fan. So the Olympics are pretty competitive tournaments, both on women's and men. So I'm excited for those to get going, which they have.
open ceremony tonight, right?
I believe so. Of course, the games have already begun. We've had rugby and some soccer and some other sports. I don't know. I feel like this year they're predominantly on the streaming service Peacock, which isn't one that's like normally on my list of things to pay attention to. I'm not hating on it at all. I just, it's only so much time and so many different streaming services. So for some reason, though, randomly, I caught some already going on, just, other sports that normally aren't on my radar so much for Olympics. So I think the games have started, but the ceremonies are tonight or tomorrow for sure.
Yeah, definitely excited about the Olympics. All kinds of things to be excited about. But for today's show, we'll leave all the sports conversations for all of those networks. This being our podcast here that we try to do about every 2 weeks. We specifically do them on a Thursday, but we moved it to today because we got some awesome news. Core PCE came out this morning at 8:30 a.m. So I wanted to kind of give more of an instant reaction to what the data shows, what it has been showing over the last several months, and what history has to say about it. So if you're joining the show for the first time, welcome. Happy to have you here. Don't forget to subscribe to the channel here on YouTube. That way, when we drop these things, you're notified, and you can check it out at your leisure. You can also go to shepherdwm.com. We have a whole bunch of our former podcasts and newsletters and blogs. Not up to date as far as most recent stuff. We're going to slow that down because I'm kind of tired of giving away all this free data and information. But the show is free, so we do want you to subscribe and like it. Share it with your friends and family because you're going to get something here that you don't get every day from other financial news outlets. I'm a huge CNBC fan. Do a lot of research with Barron's and everything else under the sun, essentially. And I know that you all, as an audience, get all this information very regularly on your smartphones throughout the day. And the news does a good job of bringing things to your attention that you should be informed about. But they are a business, and they're there to sell ads. That's how they make money. There's nothing wrong with their business model, but the one flaw that I think that is obvious to me and why we're doing this show is the news does a good job of bringing things to your attention because they understand the human being's nature. Behavioral finance has shown that humans feel losses twice as much as they feel good about making a gain. That's generally why you see most of the headline news articles, giving you that information from a concerning perspective, like, hey, this is something to be concerned about. But what the news does a really bad job is following that up with, oh, yeah, we've been through this similar circumstance 22 other times in the last 75 years. And here's what the forward returns look like for the market as a whole and for all the sectors that make up the stock market. So that's really what we're here to do. That's the edge that we bring for our customers from a performance perspective, is by using that historical data, how other human beings have behaved under similar circumstances. That way we can get some probabilities in our favor of what sectors have done the very best over those periods of time. And once we get the probabilities in our favor, now we can control our emotions. Once we have control over that, now we can actually go execute. Okay, if we want to be overweight tech and small caps and industrials, kind of like what we've been talking about all year long here, well, how much of a weighting? Well, that's completely based on what the probabilities would be for those different asset classes, performance-wise, over very similar circumstances. And the circumstances that we're going through right now is where do we cut rates? How much, how many times, all that stuff is trying to be priced into the market, along with all the fundamental data. We're right in the middle of earnings season. Obviously, earnings matter. A whole bunch of technical analysis that we're doing as well to kind of give us an idea of entry points. All of the basics, the fundamentals and the technical analysis, we wrap that around. The edge that we wrap it around with is the historical performance from other human beings making decisions under very similar circumstances. And that's what the news does not give us a good picture of. And that's really what we're all about here at Shepherd Wealth Management. It's like letting you know, yes, this is something that is important, that the news is bringing to your attention, but here's what history has to say about it. Here's how other human beings reacted. Therefore, here's the probabilities of success for all these different asset classes. And some we want to keep and some we want to avoid, definitely some we want to overweight. And that's what we're going to get into here today. So very excited to get into today's show as we talked about, all year. Well, really for, what do you think? A couple of years now, we've been on Fed Watch.
Yeah. Yeah. Almost since the podcast, certainly since SWM's inception, it's been like, how are we going to manage this and get through it? So
Exactly.
it's our favorite game of what's up with the Fed that we play week after week.
Absolutely. And well, today's news, let's just hop right into it.
Let's do it.
So we got the Fed's favorite inflation measure, and that is known as core PCE. The market was looking for 0.15%. The number came in at 0.18%. Just to be very clear, CNBC rounded that number up to 0.2, which I can't stand that. And actually, Steve Leisman, he is a CNBC economist. He's on the show every single day. And he actually called that out. He was like, hey, hundreds of percentages here actually matter. So let's not, misinform the public. I really appreciated him saying that here this morning because CNBC did round that number up to 0.2. The number was actually 0.18. So basically in line with expectations and one of the lowest inflation readings that we've seen for core PCE really almost in a couple years. So fantastic data, 3+ months in a row of falling inflation. So we're going to hear from the Fed chairman himself next Wednesday, July 31st. He'll make an announcement at 2 p.m. regarding rates. There's no rate change expected, at least from a probability standpoint. There's virtually a zero chance of any interest rate change coming up here on Wednesday. Now, there is basically 100% probability that first rate cut happens in September. So what I'm looking forward to, hopefully on Wednesday, is Jerome Powell acknowledging the really good inflation data that we've gotten here over the last 4 months. He should signal that there's likely going to be a path to a rate cut in the September meeting, should the data continue to go the way that it's going. And he'll have an opportunity to confirm that in August. So in August, the Fed does not have an official meeting, but they have a gathering at Jackson Hole, Wyoming, and they'll get together. There'll actually be an audience for the Fed to speak to because CNBC will be there. I'm sure other news outlets will be there as well. And they'll be interviewing Jerome Powell, and he should be able to basically confirm. He's not one to kind of surprise the market in a good or bad way, either with rate cuts or hikes. He generally kind of plays the hand that he's dealt, and the hand that he's dealt right now is probabilities are favoring the first rate cut to be in September. So he'll probably take that cover and execute it then so he does not shock the market in a good or bad way. Although I don't really see the point of waiting. It's going to be a 25 basis point cut unless the data can continue to show the Fed that inflation is falling way faster than they think. And that would actually be a little scary if Fed Chair Powell had to come out in September and say, you know what, we're behind the curve, just like they were behind the curve with increasing interest rates to control inflation. I think by waiting to September, there's a small chance that he may have to do more than a 25 basis point cut and admit, that they were a little bit behind the curve as far as cutting rates. I don't think that's going to be the case. The data will make it obvious, if that in fact plays out over the next several weeks. But 25 basis point cut, if that's what the market's expecting in September, and that's what you're kind of planning on doing, we'll hear all about that, like I said, next week. But why wait, 6 weeks roughly, just to cut rates by 25 basis points? Like, is the economy really going to explode to the upside with inflation over that period of time? I don't think so. So I don't really understand what the rationale would be, but we'll hear from the man himself next Wednesday regarding their path for interest rates and specifically the cutting of interest rates, which should be happening very, very quickly here. Now, why that news was so important to us here at Shepherd Wealth Management is because we had mentioned in prior podcasts, we had mentioned in prior blogs that we write. I write them every Friday almost, send them out to customers. It's very similar to the podcast show. We're showing, what's going on that week, what's the news, what does history have to say about it, and then what should be the expectations, kind of performance wise based on the way that we've allocated those customers' portfolios given that data. So it's very similar. It's just a shorter, piece that we write on Fridays. And what we've been writing about is, tech definitely has been a stellar performer of the first 6 months of the year. But the closer and closer we got to the inflection point where we're going to start to cut interest rates, well, history has shown that small caps typically lead the way from a performance standpoint. So a couple of weeks ago, we actually rebalanced. We took quite a bit of profits off of the technology sector, and we reallocated, redistributed that into the small cap asset class. It's not one of the sectors of the S&P. To be clear, there's 11 sectors that make up the S&P 500. Small caps is not one of those sectors. It's not a sector at all. It is just simply an asset class made up of a bunch of very small companies that are worth somewhere between $1 billion and $5 billion. Sounds like a lot to me and you, Ez, but the reality is those kind of numbers are a rounding error for a company the size of Apple, which is over a $3 trillion company, biggest in the S&P 500. So history would say, and we've called it out, and we were 100% right on the timing of this, which we can't always be perfect regarding our rebalance and the timing of that. But in this instance, it just made a ton of sense as the probabilities kept increasing for an interest rate cut getting closer and closer. It's just a question of, are we going to do this in the July or September? And then actually how many times? Because the market's only pricing in a little over one, getting closer to 2 interest rate cuts. So that third cut that could actually, come into the play here is not priced in the market. All of those things are extremely bullish for small caps, which is why you've seen small caps pop 10% in the last couple of weeks, whereas tech has been down almost 10% over that exact same period of time. So the timing for us, you can't say it was perfect, like perfectly timing the top of tech, perfectly timing the bottom of small caps, but relatively speaking, we did this a little bit more than 2 weeks ago. And right now we're substantially overweight small caps. And as I just mentioned, it's by far and away been the best performing asset class over the last couple of weeks. And it's about to continue. And that's really where I want to spend some time today with our audience, providing some of this historical data, because you're not going to get this on CNBC or Fox News. I have not seen anybody talk about this except for one or two folks. Fundstrat, the Tom Lees, Mark Newtons, those guys are fantastic. They're on CNBC here and there as contributors. Jeremy Siegel, professor at the Wharton School of Business, University of Pennsylvania, obviously a top business school. And most of the people that you see on CNBC, Josh Brown, Jim Lamenthal, all these guys, were not only happy to work alongside Jeremy Siegel, but most of those folks were actually students in his class. And he's using a lot of forward economic data to basically say the same thing that we've been saying all along, is that inflation is in fact falling much faster than the general public and the Federal Reserve actually think. And the reason why we know that is because the Fed, being quote unquote data dependent, as they've said multiple times over the last year, all that data, that CPI, all that information is backwards looking. It's usually about a month stale. So their data dependency is in fact backwards looking and slow, which is why we want to use all the resources we have available to us, not just the information that the Fed has, but every economic indicator, and using some of that forward-looking data to make decisions from an asset allocation standpoint. And asset allocation, for those that may be catching the show for the first time, that's the most important and most powerful thing that you have control over as an individual investor. The other one would be your temperament, your emotions, getting control over that. And again, the way that we get control over our emotions here is by understanding what history has to say, how other human beings have made decisions under similar circumstances. Again, it's not a guarantee of future results. And of course, investing involves risk, including risk of loss. But when you understand the history of the markets, now you can start to put those probabilities in your favor, and then really do a deep dive into what types of companies or ETFs or positions that you want to own to take advantage of those potential probabilities working out in your favor. We've called this out again for small caps for quite some time. But now we're actually there. And the forward-looking data, as I'm looking at this small cap asset class and the significant overweighting that we have in it, I'm just getting more and more excited. So I don't know if this is like I don't know if the audience can feel how excited I am right now, but hopefully when I'm about to deliver this data to you, you guys can understand why
We can
we are
feel
so
it.
excited.
It's coming through this. It's coming through the podcast, the live stream.
I'm feeling it. So here we go. Now, the Russell 2000. Now, that is the small cap asset class. There's a lot of ways to invest in small caps. What we use here at Shepherd Wealth Management for our customers is an ETF. The ticker symbol is IWM. That is the Russell 2000 small cap ETF. Well, that Russell 2000 index has traded up or down 1+% in 11 of the last trading sessions. Now, the reason why this is important is it's only happened 10 times since 1979. The years in which this happened were 1987, post the Black Monday, October of '87. There was a huge market crash. We call it Black Monday. But post that Black Monday event in 1987, we've seen this happen with the Russell 2000s up or down at least 1% in 11 of last trading days. So 87, 1998, it happened 4 times in 2009. It happened in 2011 and happened twice in 2020. So only 10 times since 1979 has the Russell 2000 moved up or down at least 1% in 11 of the last trading days. And the reason why this is important is these are all clear risk on years. And more importantly, these are early cycle indicators. I know the market's moved up a lot over the last 18 months, but what we're seeing here is an early indicator of a bull market, which is awesome. So there's more room to run here. But the forward performance for small caps in the win ratio is staggeringly impressive. So under these 10 instances, the 1 month forward return on average for small was 10% with a 90% win ratio. The 3 month forward return is an 18% average return with a 100% win ratio. The 6 month forward return for small caps under these circumstances is 31% on average with a 100% win ratio, and to cap it all off, the 12-month forward return for small caps under these circumstances based on history, the other 10 times that this has happened, that 12-month forward return for small caps on average is 51% with a 100% win ratio. So that is the reason why we're extremely excited about being very overweight small caps, and doing that over the last couple of weeks, from a timing perspective, just really could not have been any better. Now, all this has to play itself out. We are not 1 month into this, 3 months into it, 6 months into it, all that. History is not a guarantee of forward returns, but the probabilities are lined up. So based on this historical, not only with the first interest rate cut usually having small caps lead the way, but based on all this data that I just described here, the probabilities certainly look to be in the favor of small cap investors, and we are very much extremely bullish in that particular asset class. And you're seeing it play out today. Like I said, you've seen it play out here the last couple of weeks, where small caps has certainly dominated from a performance standpoint, whereas tech, which is usually a major winner and has been over the first 6 months of this year, has really sold off. So you've seen this rotation out of technology into these smaller caps, interest rate sensitive type of investments. Why also is the small cap investment, other than all that historical data that I just gave you, which should be enough? Well, let me give you a little bit more. Over 35% of that small cap index is smaller financial institutions. These are community banks that are publicly traded, regional banks, smaller financial institutions. Well, as interest rates come down, right? So when they start to cut rates, it's not like they're going to stop cutting after 1 or 2 cuts. They're going to continue this over the next several months, maybe even the next several years. But as we have interest rates coming down, loan demand goes up. That's how all financial institutions like banks make their profits, is having loans on the books. And that's 35+% of that index, on top of all the other biotech companies that make up that small cap index. Again, biotechnology generally does very well as we go through an interest rate cutting cycle. There's multiple reasons, fundamentally, historically, and technically, why you would want to be significantly overweight small caps. If you are, in fact, a growth investor, certainly not here to give recommendations to an audience that is not a customer who, I don't understand your goals, age, risk tolerance, and time frame. But if you have a risk appetite, this historical data, along with all the other fundamental stuff that I just described, should get you pretty excited, to add small caps to your portfolio if you haven't done so already. Now, as we get excited about small caps, we obviously have some other things from a macroeconomic perspective that would also get you excited, not only about owning small caps, but also about owning stocks in general. And the reasons are, well, the first one being the Fed cuts that we just described. Then you would have the following effect of a Fed rate cut, which would be falling interest rates, which means the cost of capital, cost of borrowing coming down. That's how financial institutions you would expect to make a lot of money, as well as biotech companies making a lot of money. The cost of capital would come down. Same thing would apply to industrial stocks, by the way. You not only have the government ready to spend trillions on infrastructure over several years, regardless of the outcome of the presidential election, as the cost of financing all the infrastructure and manufacturing. Well, that's a really good setup for industrial stocks as well. You're also going to see M&A pick up as interest rates come down, right? The IPO calendar should open up. It's really good for small caps because you generally have smaller companies. They're going to issue their first IPO, first time going public. Regional banks should improve their liquidity as interest rates come down. So the money supply should increase as there's more money available for everybody to go and utilize. That's how interest rates will come down. It's generally a very bullish thing from the market from a perspective. And depending on the outcome of the election, you might expect some less regulation. So those are just probabilities. We obviously have a long time between now and early November when the election actually happens. But the markets are trying to price all this in, using all the data at their disposal to kind of get an idea of where the best performing asset classes might be. So outside of small caps, where might you want to have some exposure if you don't already? And if you do have exposure, maybe you might want to consider increasing exposure. So we've talked about Bitcoin as an asset class. As you've been in this asset class way longer than we have, I've taken a long time to be convinced, that this asset class was truly going to be around for, the foreseeable future. And that's definitely true these days, given all different ETFs, the BlackRocks, the Fidelities of the world. Now we have an Ethereum ETF trading for the first time here this week. The way that we play that here at Shepherd Wealth Management is a lot of ways to play the Bitcoin trade. We like the miners, specifically MSTR. We really have enjoyed being in that position, and we'll continue to hold it. So as interest rates come down, interest rate sensitive asset classes like Bitcoin, you would expect to thrive. You're certainly seeing that here today. I believe last time I checked, you can check me on it, but I saw Bitcoin up about 4, maybe 5%. As we're delivering this message here, just on the news that we got today from Core PCE. Again, we haven't even gotten a first rate cut yet. They're going to be talking about doing rate cuts over the next month and a half, right? Until we actually get to September where that first rate cut happens. Again, that should reaccelerate all the stuff that we're talking about today. So we like the miners from a Bitcoin standpoint. We've talked about small caps in very good detail here today. We talked about financial institutions, right? That's a small cap play. And we also mentioned industrials. And tech also. Tech should do just fine. I know that there's a big rotation out of tech. Well, the primary winners of the first 6 months of the year, really the last 18 months of the stock market's performance has primarily come from the biggest technology companies on the planet. And we're about to get all of their earnings, except for NVIDIA's, next week. So Apple, Amazon, Microsoft, all their earnings next week. I think all of those tech companies are about to do some serious flexing from a performance standpoint. And I'll have some more to say here about earnings in just a second. So that's really kind of the approach that we're taking here from an asset allocation standpoint for customers at Shepherd Wealth Management. We're very long and very overweight caps as an asset class, very long and overweight the industrial sector of the S&P 500. The weighting there is about 8.5% for the S&P, so we're overweight that, meaning we have more exposure than that. And the other asset class would be industrials. I just mentioned industrials and small caps. The other asset class would be technology. We're actually underweight tech for the first time. I don't even think you knew that, Ez. So this is the first time we're underweight the tech sector, tech being 30% of the S&P. Right now, we're less exposed to that. That'll likely change. We do expect some volatility from a historical standpoint just before the election. Market cycles and history would show that October is probably going to be the worst month of this year. You'll probably see some backing and filling, late August and into September. So we'll probably raise a little bit of cash in preparation for that, but you're not going to time that perfectly. So I don't even go about, trying to accomplish a perfect timing of when to sell and then get back into the market here. But we might raise a little bit of cash, just kind of expecting some of that historical volatility to play itself out just right before the election. But those are the places that we want to be, and the places that we maybe don't want to consider being in, at least for the moment in time, would be energy and healthcare. Energy specifically, based on the probabilities of elections right now, Trump's pro drilling and so forth. You can be mad or sad about that. That's not really what we're here to debate. I just look at it from a market perspective of how it will affect my clients. And if you do drill for more energy, then what that does is increases supply. So if demand stays exactly the same for energy consumption, but supply is increased, that means prices of oil and those commodities are coming down, which is really bad for their share prices. And then, of course, from a healthcare perspective, depending on the outcome of the election, there could be changes as it relates to that. So we're kind of light on the healthcares, but we are exposed to some of the biotech companies. As we mentioned, that's generally a good place to be if you're going to play the healthcare space with an interest rate cutting cycle. Certainly, biotechnologies would be something to take a close look at. And that's really what the asset allocation is looking like here for our customers. Now, you might say, well, what happens if probabilities change and the outcome of the election changes from, right now there's about a 65% probability of Trump being reelected. Well, what if that changes? How would that change our asset allocation? Which is a fair question. It has to be something that we ask ourselves, and we have to consider that. Would that change our asset allocation? And my answer to that is no. And it's for the following reasons. It's because Jerome Powell, going through this interest rate cutting cycle that we're about to start, again, is really positive for small caps. It's really good for the regional banks and financial sectors. It's good for M&A as interest rates come down. So it's also good for industrials and tech. So either outcome of the election means nothing to me from a market perspective. There will be asset classes or sectors of the market, depending on the outcome of the election, that will benefit more than others. There's no question about that. But for the rest of the year, regardless of the outcome of the election, I am very comfortable with being overweight substantially in small caps, industrials, having tech exposure. Will likely load back up on tech now as we go through some of these volatile months just before the election. So a lot of work for us to do, a lot of work that we have been doing as far as rebalancing customers' asset allocations based on the inflation data that we expected. So we've been calling this out for months on months. Inflation is in fact falling faster than the market, and the Fed's giving credit for. Now we're actually starting to see that show up in the data itself, and you're really getting, again, a nice boost. Small caps, the Bitcoin asset class, industrials. The tech is eventually going to play some catch up here after a little bit of consolidation. So that's really the asset allocation plan here for the summer. We're coining this the summer of small caps, and so far so good. I'm looking forward to squeezing a lot of juice out of this particular opportunity here. And I just cannot wait for next Wednesday, where Jerome Powell is going to make some comments about what he thinks of the path of inflation and therefore their interest rate decision making. And we've actually got some of the former Fed chair members coming out and saying that inflation is in fact falling, just like what we're describing here, and that they should cut rates in July. The problem is the market's not pricing any rate cut at all coming up here next Wednesday. So that's unfortunate. I don't really necessarily see a good reason why you would hold off on making a 25 basis point cut, as I mentioned earlier in the program. But we'll find out from the man himself sometime on Wednesday afternoon, right about 2:30 Eastern Standard Time. That was pretty much the meat and potatoes of today's program, as I'm just super excited that we were able to deliver this for the audience. I know that this wasn't our typical 45-minute plus type of program here.
No, it was all gas, no brakes, though.
But the data is what it is, folks. I can't make this up. This just is how things have worked out historically. We've been calling for this for quite a while. We're very thankful that we've gotten the timing of it right, even though I will say the last couple of weeks was extremely painful to watch tech fall as much as it did without any really good rhyme or reason, because earnings were really fantastic. And since we're talking about earnings, just real quick, we've got 136 companies that are reporting this week. Of the 199 companies that have reported so far, that's 40% of the S&P, by the way. 69% of those companies have beat estimates, and those that have beat their estimates beat by a median of 6%. So not bad at all. It's definitely not an earnings recession. For a lot of those people that were looking for a potential earnings recession, you're certainly not seeing that. And next week is the second biggest week of earnings season. Again, you're going to get the biggest companies on the planet giving their earnings. That is Apple, Microsoft, Amazon. NVIDIA is not reporting next week. We'll get to them, several weeks after that. So we'll get a good look at the largest chip manufacturer here in just a little bit. But I'm very excited for earnings to continue to hold up as long as tech, the biggest players on the planet, are meeting or beating their earnings expectations. There is absolutely no reason to not be excited about the prospects of future growth here for the S&P 500, given the backdrop that we have of full employment, 4.1% unemployment rate, which is great. Everybody that has a job, or everybody that wants a job, has a job. That's 70% of our market is consumers consuming. So as long as they're working, they have a paycheck, they will consume things. That's a good backdrop. Earnings have been fantastic. You got a Fed that's ready to ease on the interest rate front. And from a historical perspective, election years are really good for markets. So I really don't see the bearishness, but yet there's $6 trillion still sitting in cash that's missed out on a double-digit market year again in 6 months.
Still.
You're not seeing a lot of leverage. Investors aren't, significantly taking on a bunch of margin debt. So these are things that we look at to try to figure out when should we start to be fearful and begin to pare back some of our overweight, taking those gains and redeploying them somewhere else. As Warren Buffett would famously say, he wants to be greedy when others are fearful. Right now, we're greedy. We've been greedy for 18 months. We're going to be greedy for the rest of this year and beginning part of next year. But eventually, margin debt starts to spike. The cash starts to flow out of cash into equities. And that's where we'll begin to call that out here on this podcast. I'll call it out for customers on a very regular basis. And we'll do our very best to get in front of that. So that's something that we'll get into most likely after the end of this year. Historically, volatility right before the election, after the election, once the results are known. I think the whole world, specifically U.S. investors, are thankful that that process is now over. And generally, you see a really nice rally to end the year in an election cycle, which kind of lines up really nicely with earnings. So we'll be going through Q4 earnings for all the big tech players and everybody else right around the same time once we know the outcome of the election. And again, we could see an additional third rate cut in November as well. So there's a lot of reasons, historically, fundamentally, technically, why you would definitely want to be very, very bullish for all the asset classes that we just described here today. So it's not going to be a complete melt up where every sector, is just ripping and roaring. You certainly want to be overweight and underweight, these various asset classes, depending on your age, risk tolerance, goals, and time frames. So that's up to you to decide. As you may note, I did not give the audience the exact weightings for any of the things that we're doing here. So what I will say is that when we do this kind of research and the research shows us these kind of probabilities, we're not shy. We let the research dictate our decisions. We are data dependent, but we use a lot of different data, not just the backward-looking data that the Fed's looking at. So it's certainly been an edge, and we love doing this for our clients. We're very thankful for the opportunity to do this for our clients, and we need more clients. Just to be quite frank, I mean, there's more and more people in this country that need what we're doing. They absolutely do. And we'd be happy to help. Just give us a call, 513-630-2664. Go to shepherdwm.com. You can schedule an appointment. You can find out all there is to know about myself and this company and our president, John Ashcroft, and everything that we do here in our community is all there right there for you. So we're very excited. We're happy to do this. We're very blessed to be in a position to do it. And now that we can do this the way that we want to, after leaving the corporate world and starting this company just a little over 3 years ago, we're thankful to have clients in 11 states, $100 million to manage for them. We continue to grow, and we'd love to continue to grow with you. So with that, I think that's all we got. Ez, I didn't see any texts or questions coming in.
No, no,
Um,
viewership was quiet. You must have just been enthralling everybody with your speedy data, your historical precedents. I loved it.
yeah, and I'm not cutting it short because it's a Friday, but this is the data. This is the data. It's awesome. There's nothing else to say. To me, this is a mic drop kind of moment for the market. I mean, Powell should be confirming all this stuff. I don't know how he couldn't. I don't know how he could basically say we need more information. At this point, like that would piss me off if he says
Yeah,
that on Wednesday.
that would be another thing in my brain where I'd be like, is he trying to break something on purpose?
Yeah,
Which I don't think he is. I want to tell everybody that. It would just make me think that. Like I don't think Powell's intentionally trying to crush anything. I think he's
right. And what I think would happen there is he would just get completely peppered, just drilled with questions. Like what else do you need to see? Like what else could it possibly be? Because he already mentioned that he can begin to cut interest rates before we get to 2%. Well, the year-over-year PCE is 2.5.
right.
So that's where we're at, folks. And like I said, I would go 45 minutes here on today's podcast if there was a lot more to talk about, but the data is what it is. It's awesome. You're seeing it live in time, and the more and more people buy into this, which will likely happen next Wednesday, as long as Powell doesn't try to convince everybody that inflation, could potentially go back up. Like that would just be ridiculous to say. We'll have to watch and see what he says. Outside of that, if he kind of gives the green light himself next Wednesday, I think that you see margin debt go up. I think you see a ton of cash come off the sidelines into the market and all these places that we're talking about here. And we're already positioned for it for our customers at Shepherd Wealth Management. So we're going to ride this wave and enjoy this summer of small caps. So I hope you all enjoyed the program. If you really are, enjoying it, please give us a like, maybe leave a comment. You can certainly go to Google, type in Shepherd Wealth Management in the Google search. You'll find a way to leave a Google review. We always love hearing from our audience and our customers, and we'd love to hear from you. So we'll do this again in a couple of weeks.
Yeah, and I just want
As we
to
get
add on to that real quick, Joshua. If you're coming to this episode or these clips on YouTube or anything like that, if you're finding these on Spotify and you're not necessarily paying attention to the live stream, still, if you have questions, please drop them in the comment section, or we keep the text number for the actual business, the Shepherd Wealth Management, on the stream. And any questions, send them in, and Joshua will answer them. Either live on stream or through the comment section as well. So please, we love it when people want to engage with us. So
Yeah, a ton of fun, and the more engagement, the better, the more fun that we have with it. So, again, I know that this isn't something that you've likely heard on any of your favorite news, programs. You're hearing a lot of people talk about this small cap rally being, short-term lived. The reality is there's more short interest in small caps than really there has been in the last couple of years. So as small caps continue to move in the direction that history would show that they should move, and then I expect them to move in a similar fashion, you should see a ton of small cap short covering, which is a very good reason to want to own it, because as they have to cover their shorts, it means they're buying small caps, pushing the price even higher. So with that, I will leave it for the next time when we do this in a couple weeks. I hope you all enjoyed the program. My name is Joshua Casey Garland, founder and CEO of Shepherd Wealth Management, and certified financial planning professional. I'm very happy to deliver this information to you today, and I hope you take advantage of it. Enjoy the rest of your summer, and we'll see you again in a couple weeks.